before I get into our investment thesis on KKR, I want to first set up the high-level framework we use to identify great investment opportunities. And really, our formula for success is to identify large, reliable structural transformations that have favorable economics. And then we seek to own the businesses which are what we would call high probability long-term winners within those transformations. And then, of course, only when they are undervalued by equity markets. And the reason for just setting up this simple framework up front is because we think that KKR satisfies these three criteria today. So we're talking about KKR, and first I just want to lay out what this business looks like today. And you can get a sense from that just from this introductory slide. And the bulk of this business, was traditionally in private equity, but as you can see in the chart over recent years, it's rapidly growing its infrastructure, real estate, and credit businesses. It's got around $500 billion of assets under management, offices in 17 countries around the world, and it really is a true global investment platform. Now, if I were to summarize our thesis just in one slide, this would be it. So we see KKR as a high probability long-term winner in the alt space. Been around for nearly 50 years, great track record, great product suite, clear demonstrated history of capital recycling. And that basically means, when invested assets are realized, nearly all of this capital is reinvested by LPs. They've got the largest Asian alts platform, and I'll speak to the importance of that in a few moments. And KKR is very well positioned in long-term structural transformations, which we'll touch on. And there are three that we really want to highlight today, which I'll get to. These are in Asia, insurance, and the retail private wealth channel. And each of these have very large TAMs, and you put the three of them together and it represents an enormous TAM and big opportunities for this space. And so with all that, the question is, okay, is this priced into the stock today? And the answer is, in our view, far from it. In fact, very little of this is priced into the stock today. And what we'll do is we'll show that the core asset manager of KKR is valued by the market today at around 11 times fee-related earnings. And that concept of fee-related earnings, you can think of that just as the earnings that kind of stem from the management fees. So kind of like a recurring measure of earnings. And then 8 times distributable earnings, which that includes, all the lumpy realizations and associated performance fees as well. And so we think, even conservatively, we think that the investment upside from current levels is more than 2x today. So now let me dig into some of the bottom-up characteristics of KKR, which I think speak to its business quality. And really, this is the basis for our assessment that KKR is a high probability long-term winner in the space. And I would also add, along with Blackstone. So this isn't so much a relative call in quality between those two. I think both are very high quality. It's just that I think KKR has a very interesting kind of value investment opportunity today, which we'll get to. So KKR has been investing its clients' capital for nearly 50 years, as I said. And I think it's easy just to forget how tenured this group is. And so they've built, again, along with Blackstone, they've built this world-leading brand, great long-term track record. And what these advantages do is they really help enable talent attraction and retention, which is a big deal in this space for obvious reasons. They help enable access to deal flow, client attraction and retention. And it's something that, they've built up over half a century. Competitors can't just, replicate that in a day. So that's a nice advantage. KKR has consistently demonstrated a strong ability to retain capital via asset recycling, as I mentioned. So of their $510 billion of AUM, more than half of this is what they call perpetual capital. and most of the balance is very long duration in any event. So again, it's really a reliable set of earnings power that this business has. KKR's product diversification has increased substantially over time. So again, remember that very first chart I showed. You can see the real build-up of real estate, infrastructure, and credit in recent years. And this only increases KKR's ability to serve clients across a wider range of channels, particularly the newer channels such as insurance and retail and private wealth, again, which we'll come back to. And KKR is the Asian leader in alts, with its Asian AUM increasing more than 3x just since 2019 alone. And KKR actually believe that their Asian business will reach the size of the Americas, their American business, over time. And just to put that into context, currently their Asian business is about a third the size of their American business. So it really speaks to, where they think the growth will be. And as I said, we'll come back to that in a moment. So in addition to this, we think that KKR is also very well positioned in several attractive long-term structural transformations that are taking place in the alt space today. And as I said, these relate to Asia, insurance, and this sort of newer channel in retail and private wealth. So I first just want to touch on the important implications here for the industry and KKR that stem from these structural transformations. So we place a very high probability that aggregate industry AUM will be much higher in the future than it is today. And we also place a high probability on the fact that we think that the most recognizable brands in the space, such as your KKRs and your Blackstones, will actually capture a disproportionate share of that growth, i.e. they'll increase their market share over time. And that's not really a sort of an outrageous claim. All that's really doing is saying that we think that we'll see more of what we've been seeing. And it's sort of an argument to say it's like a winner-take-most type of situation rather than the growth being kind of, uniformly distributed across all players, large and small. Now, there's plenty of room for the industry to grow. I think that's an important point to understand. So the industry's assets today are at 10 trillion, which obviously is an enormous number, but relative to the total pool of global stocks and bonds and real estate, which sort of roughly add up to around 300 trillion, obviously 10 out of 300 is relatively small, around 3%. So enormous room for that 3% to increase over time. And we'll explain why we think that's going to happen. And then just within that 10 trillion of alt space, just a couple of numbers to keep in the back of your mind. So KKR currently has 5% market share and Blackstone 10% market share. So again, we think not only the space is going to increase over time, but then KKR's share of that space, currently at 5%, also has plenty of room to increase over time as well. So let's now take a closer look at each of these three major transformations. And we'll start with the large Asian opportunity. And I'm sure most of us are already aware by this point that Asia accounts for, at least half of global economic growth. And that's the chart on the left-hand side. And those measurements are sort of for the 5-year period, 2022 to 2027. But what's really interesting, I think, is that the penetration of alts relative to GDP is really very low in Asia on a relative basis. So, and that's the chart on the right-hand side. And so you can see that the penetration of alts in Asia is, half that of the level in Europe and less than a quarter that of the level in North America. So with these two dynamics, one, rapidly growing economies, within that Asian regions. And then 2, structurally increasing penetration. We think, as KKR thinks as well, of course, will combine to turbocharge growth in that geography. And as I said, it turns out that KKR is the alts manager with the market-leading position in Asia. So that's a nice combination. Just digging into KKR's position in Asia just for a moment. So they've been going for almost 20 years in this region. Nearly half of their offices are located in Asia and the Middle East. They've got the largest Asian-focused PE fund globally. They've got the largest Asia-focused infrastructure fund globally. And as I mentioned previously, currently that business in terms of assets, which by the way has tripled in the last 4 years alone, so they've got plenty of momentum. It's still a third of the size of the Americas, and KKR thinks that it will ultimately reach the size of the Americas over time as well. So I think a big opportunity there, and things definitely heading in the right direction for what is the market leader in that region. Okay, now let's just jump to the second industry transformation that is well underway, and this relates to insurance. And specifically, we're talking about strategic partnerships that have been taking place with insurers for these alts managers to access very large pools of capital. And of course, that's the obvious benefit for the alts manager is just, you get this fees on a very large pool of third-party AUM. They often also come with, guarantees or commitments for growth in AUM from the insurer over time. And sometimes these alts managers will also take an equity investment in the insurer as well. So there's potentially upside through that lens as well. In thinking about these deals from the insurer's perspective, there are advantages in that they achieve better yields on their assets. And that's not just like a sort of a statement of superior investing acumen, although that probably exists as well. But it's also saying that what these alts managers are very good at doing now is providing really dedicated products and structured products tailored for the insurer that help improve yields. And then things like, preferred access on deals. Sometimes there are, fee discounts and whatnot. So that's obviously really attractive for the insurer. And then, as I said, sometimes these partnerships also are associated with an infusion of fresh equity capital into the business, which can facilitate, growth or whatever they need to do. So you can sort of see through this lens, these partnerships really appear to be win-wins. And they've really started to accelerate over time. You can see just in the bottom left-hand corner, there's just a list of recent deals that are really starting to take off. But yeah, through this lens, this space is sort of evolving to become kind of more and more like what Berkshire Hathaway has been for many, many decades, in a sense, which I think is really interesting. And the TAM here is really, really big as well. So this insurance opportunity represents another 30 trillion AUM opportunity over time for the alts industry. Now, moving to just a few of the bullet points on the right-hand side. So that's the left-hand side is all about the industry, and the right-hand side is just about KKR's situation specifically. And they acquired a majority of Global Atlantic in 2021. And just that one deal alone boosted their AUM by $139 billion. So these deals really can be transformational for the alts businesses. And then, of course, there are, as you'd expect, Global Atlantic is a standalone business. It's got its own strategy in place to continue its AUM growth. And then over time, of course, to the extent these initiatives are successful, that will essentially just raise additional AUM for KKR. So it's a really neat sort of source of growth for these alts managers over time. Okay, now the third major long-term transformation relates to the retail and private wealth distribution channel. Now, historically, of course, the lack of liquidity associated with private equity products has led to the conventional wisdom that, alts are not really suitable for this channel. This is really starting to change. And the reason why that's really interesting for these guys is because the size of the prize is absolutely enormous. So as you can see on the chart on the left-hand side, basically it's saying, look, roughly 2/3 of all client assets reside in this channel. And then more specifically, Blackstone have pointed out that there is $85 trillion of wealth in accounts where people have more than $1 million to invest on average. So really, really big TAM here. And the other interesting thing, it's got this dynamic a little bit like the Asian situation, where if you look at the chart on the right-hand side, there's this structural underpenetration today for historical reasons. And as we said, we think that's changing. But if you were to imagine, well, where could the penetration grow to? Well, currently the penetration of alts in the portfolios of individual investors is less than 5%. And then you compare that to, say, pension funds, where it's around 30%. Endowment funds, it's up north of 50%, which is extraordinary. So you put that all together and you say, wow, okay, this is a new channel. It's a big opportunity. The estimates are, in terms of what's tangible and achievable growth for the industry on a 5-year period, is about an additional 10 trillion of assets. And recall, that's the size of the entire alt space today. So just from this one new channel, basically the entire alt space is expected to double in size over the 5-year period. And then importantly, as I said up front, we think this growth will be disproportionately captured by the world's leading brands in the space. So it won't be equally shared by everybody. We think that the big guys who have great global reputations, great long-term track records, will basically take the lion's share of the spoils. And it's also worth pointing out, a lot of these products are distributed via the wirehouses, and there's limited shelf space in a sense. They don't take 100 or 200 or 500 different products. They basically take the top 3. And, if you're not in that top 3, then it's very, very hard to be distributed. So, of course, that really favors the big global brands with the great long-term histories, and especially those who have been early in investing in this distribution channel. And it's worth saying that KKR is one of those players. I think arguably Blackstone's the leader, but KKR is probably the number 2 here in terms of proactively investing in this channel in preparation for this opportunity. So you can see on the right-hand side, just a couple of points. KKR has, just over the last 2 years alone, tripled its sales force in this channel from 100 to nearly 300 people. And they've recently launched their democratized vehicles. And this is just in the last few months. This is just this year. So, distribution has really commenced in this space. It's really starting to ramp up. Currently, this channel represents about 15% share of new AUM for KKR, and they think that this share of new incremental AUM will jump to as high as 50% over time. So that's obviously a big uptick and really speaks to the size of this opportunity as well. So I've thrown a lot at you there, and I just want to kind of summarize those 3 transformations in one simple chart. So Asia, insurance, and the retail private wealth channel. We've talked about the reasons why we think that those are really structurally growing and reliably growing over time. The leading players in each of those spaces, you can see that KKR features in the top 1 or 2 in each. The size of the prize collectively add up to many tens of trillions of incremental AUM. over and above the current industry size of 10 trillion. And then what really matters is the size of that incremental growth that will be captured by the leaders, the KKRs and the Blackstones of the world, relative, so the percentage uptick relative to the current size of the business. And, as I said, for a business like KKR, it's 500 billion to be able to meaningfully participate in structural transformations that amount to the tens of trillions. It's really a big deal. We're talking, multiples of growth over time. So that's why we think the transformations are interesting. That's why we think KKR is very well positioned within these transformations. So now I'd like to just spend a few moments on the valuation of KKR today, because it appears to us that KKR is really being misperceived by the market, and we'll come back to some of the reasons why that might be in a moment. But first, just on valuation, let me show you this table. Now, I know it says simplified valuation and it looks like a very complex table, so you don't need to go through it all. I'll just make a few sort of high-level comments that I think tell the story. Essentially, we arrive at a valuation of 11 times fee-related earnings for KKR's core asset manager. Now, to get there, you start with a market cap of around 45 billion. But importantly, this includes around 25 billion of balance sheet investments. And actually, this really large balance sheet of KKR's is one of the reasons why we think this stock might be misperceived a little bit. So what we do to value this business, we kind of move those 25 billion of assets to one side for a moment. And then we compare the residual 20 billion of value that relates just to the core asset manager with the earnings, again, just from the core asset manager. And that's how you get to that 11 times. And by the way we think about earnings, we do fully expense stock-based comp. I know some people kind of put that to one side. We don't. We just assume that that's an expense, and we deduct that to reduce our earnings. So yeah, 11 times fee-related earnings, 8 times distributable earnings. For a business that is almost assured to grow north of double digits over time with near zero capital intensity, that sounds to us like an interesting opportunity. And by way of comparison, Blackstone is more than twice these valuation multiples. So that's really interesting as well. Like on a relative basis, there seems to be quite a big disconnect between Blackstone and KKR. Let me just opine for a minute on a couple of the reasons why KKR might be misperceived by the market today. And as I said, the first reason really relates to that balance sheet effect that we just described. So I think, to some extent, if you just did a really cursory analysis, you sort of took, value divided by earnings. I think a lot of people are including the balance sheet in the numerator. And then sort of looking just at the earnings of the asset management business in the denominator, and it's a little bit of an apples to oranges comparison. It would actually make the stock look much more overvalued, or sort of much more highly valued than it is in reality. So I think that's one reason. The second reason relates to the distortions to fee revenue growth rates that stem from KKR's cyclical transaction fees. So, around a fifth of their revenues come from their transaction fees. So these are basically, like investment banking fees. You can think of them like that, on their own internal deals. And they move, up and down. They're much more cyclical depending on the environment and depending on the extent of the realizations that are happening in any given period. And you can see in the chart there, those kind of the top bars, those sort of red bars, and they move around. And of course, what they do is that they mask the really kind of reliable growth in the management fees, which are the dark blue bars. And so I think that's another reason why KKR is a little misperceived today. So for example, in the most recent quarter, total revenue growth was negative 4% year on year. You say, well, that doesn't sound particularly attractive. This is meant to be a structurally growing, really reliable business. Well, that's all because these transaction fees were down by half just on that sort of year-on-year comparison. Whereas the underlying management fee growth is just a really nice, smoothly growing, like 18% per year, sort of year on year. So I think that's one of the reasons as well for the misperceptions. And then another reason for the market's misperceptions, we think, sort of relates to the stark disconnect between current earnings growth and the earnings growth that we basically know for sure is coming. So as I basically just said, like the current earnings growth is pretty much like flat to down. And this is, as I said, in part due to the cyclical transaction fees. And it's not being helped by a pretty weak fundraising environment today, especially in traditional private equity. And what's going on there is that the weak equity markets, particularly of 2022, caused a lot of potential asset realizations to be delayed. Of course, you don't want to sell assets into a weak market. But this has a knock-on effect. This in turn causes a delay in fundraising because so much of fundraising is simply just the recycling from those realizations. So if one stops, the other stops. So near-term earnings growth is pretty lackluster. And I think that's contributing as well to the low valuation multiple that we're seeing in the market. And we think that the market or certain analysts are sort of extrapolating this period of low growth into the future. And we think that that's a really big mistake because of something that we call the large inflow effect. And essentially, this is about the delayed effect on earnings growth from periods of very strong asset growth. And so, as you can see in the chart on the right-hand side, which shows KKR's AUM over time, 2021 was a massive step up in terms of growth. It was unusually large. Now, what this actually means in terms of impact to the P&L is that this obviously it has an impact in the years following 2021, but it actually has an outsized impact probably around 2026 when a lot of those assets are first realized. So they've been invested, and then you can obviously earn management fees on essentially like the cost basis of those assets as they're invested in 2021, 22, 23, 24, 25. But then when they get realized, let's say, $1 that was invested in 2021, maybe in 2026, it gets realized and maybe it's $2, that gets recycled. And then you get that almost doubling of management fees around 2026. So there's this sort of delayed step up in earnings power of this business, which is essentially locked in today, and it requires no additional capital investment to achieve. And so that significant increase in earnings power in the business that is essentially locked in and will materialize, around 2025, 2026, that does not appear to be reflected in the stock price at all today. And so again, it speaks to the undervaluation of this business, and it speaks to the investment opportunity. So let me just again wrap up by underscoring the key points of our investment thesis. So high probability long-term winner in the alt space. I think we've established that. Very well positioned in three really important long-term structural transformations: Asia, insurance, and this new retail private wealth channel. And as we've argued, we think that the spoils will favour the leading brand names like a Blackstone and KKR disproportionately. And if that's true, then the asset growth that is on the horizon from these transformations is really very large compared to the existing asset base of KKR. And we think that KKR is significantly undervalued today for the reasons I described. And we think that the misperceptions that exist in the market today are stemming from both the balance sheet distortion that we described, but also the optically depressed growth in earnings that we're seeing today, which we think is masking the true underlying earnings growth of this business. So, as we said, this just from its 2021, a huge raise in assets alone, there will be significant growth when you look out sort of to 2026 and beyond in earnings. And then, of course, not to mention the three very large transformations that we've described. So we think that this business is actually a reasonably high growth business with essentially next to no capital intensity in order to achieve said growth. And of course, as we said, this thing's being priced at around 11 times fee-related earnings, which to us is basically saying that, the market sees, it's almost saying no growth forever, which just really doesn't make sense to us and to us represents a classic mispricing in the marketplace. And so, given this valuation disconnect, we certainly weren't surprised to hear on the most recent earnings call that management are now really sharpening their pencil and looking at sort of accelerating stock buybacks in a more aggressive way. And that makes sense to us. And then the final point that I would make, which I don't think I've made yet, is that KKR insiders own 30% or around 30% of the shares outstanding. So that's a really important point as well, because it says that you as a passive shareholder, you really are aligned with the insiders of this business. And as you can imagine, in these sorts of businesses, the principal agent risk is potentially quite serious if incentives aren't aligned. But in the case of KKR, incentives are very well aligned, and so that's a nice setup as well. Okay, so that is the end of the presentation, and I'm happy to jump to some questions, John.
Wonderful. Thank you so much, Andy, for the presentation. There's a lot in principal investments on the balance sheet, as you pointed out in the valuation exercise. Is that something that KKR views as core and will sort of hang on to, or would there be an opportunity to perhaps shed some of those investments over time and perhaps highlight the low enterprise value that way?
Yeah, look, it's a great point. They are acutely aware of this disconnect, and they go to great lengths to point out their balance sheet to anybody who is taking the time to kind of roll up their sleeves and get deep into these financials. I mean, it's an interesting philosophical argument, because they would say, well, hang on a second. It's wonderful that we're using our balance sheet to co-invest in, I guess, what they would describe as like the super interesting, really amazing opportunities that perhaps maybe their existing funds they're full up on, maybe they can't do more, and so they use their balance sheet to co-invest and really take advantage of the opportunities that they see in an even more significant way. Philosophically, that's a good thing to do, but then practically, you create this misperception that we've just outlined, which is then really not getting credit for the true value of their core asset manager, because it's being distorted by this big fat balance sheet. As you rightly observe, there's simple ways to solve this if they really wanted to. And they could run that balance sheet down. They could distribute it back to shareholders. All sorts of things that they could do. And I think if push came to shove, they probably would go down that path. I'm not sure that they'll even need to do that, but we'll see. I suspect and this is, predicting the behavior of the market is not something anyone should do, but with that disclaimer, I'll go ahead and do it anyway. I suspect that when earnings growth of this business starts to reaccelerate in the same way that the current period of low earnings growth is being extrapolated nonsensically, in a nonsensical way, I should say, I think that the return of earnings growth will also be extrapolated and the multiple will re-expand over time. So in a sense, I don't think they're worried because they know that the growth is locked in and it's coming anyway. It's just a matter of time. I think that they are looking to opportunistically take advantage of the depressed stock price today. And that's, as I said, they're going to ramp up their stock buybacks. And I think that makes sense. I think they should do that in a far more aggressive way because there's arguably no greater opportunity for, any dry powder that they have is to buy their own shares today. But I think if that still doesn't work, then they may look at other sort of capital management techniques to try to shine a light on this valuation disconnect that we see today.
You make a good case for the big brands kind of soaking up more assets over time. I'm just wondering, when it comes to Asia, are there any major homegrown Asian firms that would compete here for deals? It seems like maybe American companies wouldn't always be advantaged in some Asian markets if there are local alternatives.
Yeah, look, I think that's a fair point, and there are in every country homegrown players. I think the advantage that you have if you're a true global platform, though, is that you can, in their case, for example, raise capital out of the US or out of Europe or the Middle East to invest into Asia. Now that sort of distribution platform is something that, say, a homegrown Asian firm just would not be able to do very well. They just wouldn't have the resources or the contacts or the networks to raise capital abroad to invest locally. These businesses, even though it's all about investing and it's all about the returns that they generate on investments, at the end of the day, they're really gigantic distribution businesses. And you really do need a global footprint to be able to kind of do what these guys are doing. The other thing that they have is, and I mentioned it right up front, but I think it's important and it's often overlooked, is the brand and the track record and the history that these really big global platforms have. It really helps talent attraction, and that includes like local Asian talent attraction. So if you're a young, hungry, super smart investor in an Asian country, do you want to work for the homegrown shop, or do you want to work for the big global platform where there are opportunities to do what you do at a much larger scale? There are also international opportunities if you want to spend time overseas and learn different geographies as well, different sectors. So, I mean, I think that's also really important. And the final thing I'd say as well, remember, even though we're talking about these businesses which have enormous pools of assets today, I mean, 500 billion for KKR and almost $1 trillion for Blackstone, which sort of makes your head spin. Even though I've pointed out that as a percentage of, total assets out there, it's still a tiny, tiny fraction. So they've got a lot of room to grow. But in terms of headcount, these are actually pretty, reasonably small firms still. We're talking low single-digit thousand employees, like 3,000 or 4,000 employees, around that level. For a business that, as I said, it has something like 23 offices around the world. Like these, even though they're investing in every industry, in every asset class, almost every country around the world, they're still pretty, pretty slim, pretty lean, pretty efficient. And for that reason, I think that they can be pretty agile. I think that they can therefore, compete with local specialists and local geographic specialists as well.
And can you just elaborate a little bit on how KKR compensates its people?
Yes, so it's a pretty simple formula, and I'll just use general numbers because it varies a little bit firm by firm, but around 20 to 25% of the management fees are carved out for employees, and then around 60 to 65% of what they call the carried interest. So you can think of that as like the performance fees on investments that they make, which all come in once the investments are realized, if it's 5 or 7 years into the future. As I said, around 2/3 of those are carved out for employees. So those are the two sources of, what you would call the bonus pool. And then, of that, a portion gets paid out in stock-based comp and a portion gets paid out in cash. And as I said, the stock-based comp piece is important, I believe, to drive alignment. KKR is very, very strong on that dimension, as the point that I made right at the end. 30% of total shares outstanding are owned by insiders, which is really remarkable, I think. And as I also said, the way we value these businesses, we fully expense the stock-based comp. We don't sort of play any games and sort of assume that it's not a real expense or anything like that. We try to be as conservative as possible, and we fully expense them. But yeah, so through that lens, even though these businesses, if I was about to say through this lens, these businesses are really easy to model, because you just say, well, we know exactly what percentage of management fees gets paid to labor, and we know exactly what percentage of carried interest gets paid to labor. And in a sense that's right. The reason why I kind of laughed at myself saying these businesses are really easy to model is because the gap accounting of these businesses is really, really like complex and almost unintelligible. And actually, you need to heavily rely on the non-GAAP accounting and the deconsolidated accounts that they provide. But you can make your way through that. And once you do, then you can see that actually it does sort of collapse to that very simple formula. Management fee times 25% is plus carried interest times 65%. That is the labor expense of the business in any given period.
It makes a lot of sense. Thank you for that. So just my last question. If we want to track this idea over time to gauge how the business is performing and the thesis is playing out, what would be some of the key data points to keep an eye on?
Yeah, I think that measure of fee-related earnings is one of the most important. And as I said, I mean, that's another reason why perhaps these businesses are misperceived a little bit, is they've got their own sort of jargon associated with their different measures of earnings. So in the industry, they talk about fee-related earnings, which is essentially just the management fee revenue minus the portion of the labor expense that relates to the management fees. So as I said, it's around 20 to 25% of the management fees is paid to labor just from that particular source of revenue. So what you would expect to see if this thesis is working well is that the fee-related earnings, particularly around 2025, 2026, should just step up in a really, really meaningful way. And where that will come from is that the realizations of all the assets that were raised in 2021 and invested throughout the course of 2021, 2022, 2023 will start to be realized. That'll actually kick off tons of performance fees and carried interest as well. But I'd really, obviously they're lumpy and they come and go. I'd really encourage investors to to try to stay focused on the trajectory of fee-related earnings. That is ultimately going to come from management fees, and management fees is ultimately going to come from assets. So that is how you would track what I would call that the 2021 effect. You know, that really big step up in assets that were raised. And then beyond that, I would just keep an eye on the progress of this new private wealth channel. The opportunity is enormous. The timing is less knowable, I would suggest. So we don't really know if that's really going to take off on a 1 year, 2 year view, or if it's a 5 year, 6 year view. But the opportunity is real. It's there, and it is starting to build momentum. And then I'd say the same thing for Asia as well. Again, KKR is the leader in Asia. They've already demonstrated tripling of their assets in the last 4 years, but you'd want to see continued growth in assets out of Asia to have some confidence that was also heading in the right direction.
Terrific. Well, I will leave it there. Andy, thank you so much for joining us and sharing your thesis on KKR with the MY Global community. We truly appreciate it.
Great. Thank you, John. And thank you, everyone. It was a real pleasure.